Hey everybody, it's Osman with House Einstein, and I thought I would put together a analysis of what's happening right now in Boulder real estate, and we'll do it in a PowerPoint slide deck so that I can illustrate some of the communications that are happening in the Boulder real estate community. Okay, so you ready? Let's go. Um, so at this moment, I'm getting a lot of emails from other agents and market participants to try to explain what's happening in the market and reassure buyers and sellers. And this is an example of some of that communication. This is from an email I got this morning from another prominent real estate company. I'm not going to name them. They are a big player here in Boulder, but this is the message they sent out this morning. So let's use our handy tools here and give you a pointer. So there's no question that, how about some good news? There's no question that we're living in a time of uncertainty. We can't control some of the unprecedented unknowns and subsequent consequences on markets and people, but here's what we can do. We can look at facts and we can focus on what we do know. Of course, no disagreement with any of that. We should always look and focus on the facts, but unfortunately, that's not what the rest of the communication is about. So here's what they say we know. Boulder always responds to adversity the right way. That doesn't really seem like a fact to me, and I'm not sure what the right way is. The market is the right way, and the market is what's going to set the tone of what's about to happen. So Boulder is one of the happiest, healthiest, and most amazing places to live. Also, I agree with it's an amazing place to live, but not exactly a fact. And then Boulder real estate has a proven track record of being an incredible investment. That is true. It has been an amazing investment both for my personal investment portfolio and for many of my clients. But this is the interesting part. So they write, in fact, through the darkest days of 2000 of the 2008 recession, the Boulder housing market was stable before making an incredible recovery, was stable. So as I'm going to show you later in this presentation, the Boulder market was not stable in any way, shape, or form. But let's take a look. So in that same email, they included this chart, which I had to zoom in to get a better look at. And I hope you can actually see the chart on your screen and it's not too fuzzy. So this is from the Federal Housing Finance Agency. It's a federal government agency, so their data is pretty good. And it's for Boulder, Colorado, which almost certainly means the county, not the city. And it looks back all the way to 1979 for annual home appreciation. And they say annual home appreciation is 5.7% over that extensive period of time. So over 40 years, that's what you can expect. And my data shows that too, that Boulder has outperformed. But that's not to say there haven't been down years. And here's one example back in 83. And if you can look at the number there, that's negative 5.5%. But the 2008 global financial crisis and the last serious downturn in Boulder real estate is what I want to talk about. And remember, this is what the this agent and this company says was stable. And so during that time, we saw appreciation basically flatline in 2008, 0.4%. And then we had 3 years of subsequent price declines before prices started to come back around 2012 and started to appreciate again. So this is that period of that they described as stable before it came roaring back that I would argue was not stable, and during which time it was more difficult to sell homes that were in difficult locations, challenging locations, and particularly, and I'll show this in an analysis later in this presentation, particularly at the higher end of the market. So again, keep in mind, this is the county, this is not the city. It's everything in Boulder County, all of the L's and the city of Boulder, as well as unincorporated Boulder County, is all lumped together in this data set. The email goes on and it says, sure, some nervous sellers are pulling their listings off the market temporarily, and some buyers may not be ready to commit to a new home this week. That's true, of course. We're seeing that with our business too. With our clients, some of them are hitting the pause button. And it says these are temporary issues and mortgage rates are at all-time lows. Uh, and we have low inventory in our market. So we believe these setbacks are just temporary. I blacked out the brokerage's name, but they say our blank brokers, our blank agency's agents have closed several homes this week alone, and in some cases, we're seeing multiple offers on new listings. So we've seen the same thing. We've closed several homes this week, and all of those buyers were a little hesitant, but decided to move ahead. Probably the right move versus losing their earnest money deposits. And of course, they plan to stay in these homes for many years, so I think it was the right move. But we certainly understood why they were hitting the pause button. And as for seeing multiple offers, it may be possible. It wouldn't surprise me, particularly at the entry level. I'm not arguing that. And then the email goes on to say nationally, experts are telling us this is not a housing crisis like we experienced in 2008. And to that, I would say not yet. And I'll tell you why later on. And then the email goes on to say there are, in fact, market differences. Americans are not over leveraged. Many have incredible equity. Of course, that was true in 2006 and 2007 too. Additionally, the lending systems are strong. They're certainly stronger than they were in '06 and '07. I would argue that. But then then the email goes on to talk about, hey, Goldman is saying that the second half of 2020 is going to be great. We've got gains coming in, and during the beginning of 2021. And remember, an economic recession does not equal a housing crisis. So in my 17 years of obsessing over real estate in general, and specifically the Boulder market, I can tell you that housing markets, primary housing markets like Denver and Boulder, are in line. They tend to track the general economy and unemployment in particular, while secondary markets like Aspen, Jackson Hole, resort markets, Vail, and other places around the country like Nantucket, where I got my start in real estate, they tend to track the stock market much more closely. But primary home markets, again, are very fixated on the general economy and unemployment numbers. So an economic recession can very much track the housing market, although it doesn't necessarily mean there's a crisis. So let's keep going. So here's that Goldman study that agency's email referenced and said, hey, Goldman is saying the second half of the year is going to be great. Well, Goldman's also saying the first 2 quarters are going to be horrific, which that email conveniently ignores. And then it says the full year GDP growth is going to be 13.8%, and unemployment they're forecasting is going to grow 5.5% from the current rate of 3.5 to 9. That's what Goldman is saying, and Goldman also said our economy is recession proof back in December. So take all of that with a word of salt. I don't know if Goldman's analysis is any better than anyone else's, but that's what Goldman is really saying, is we're going to see 2 quarters of down. The second quarter in particular is going to be horrific, and then we'll start to see quarterly growth from that point forward. And there's a lot of assumptions, by the way, built into that around COVID-19 and our approach to handling the virus. There's so much uncertainty in this forecast that it's basically just their best guess. So this is another email from another broker who sent this to me, and I think he added me to their client list. I'm kind of surprised I'm getting these types of emails. So he wrote, the reason for this message today is that a lot of people were asking what's going on in the market, what effect is the pandemic having on real estate? And I talked to realtors all over the country, and everyone says it's pretty surprisingly good, except for Utah, and business as usual. But that could stop at any time. Okay. So then he goes on to his anecdotal business, and he said, last week we put a couple of properties on the market, and they've had 25 showings and multiple offers. Of course, he doesn't say that anything went under contract. And then he said an agent he talked to in Louisville yesterday said the same thing. So again, more anecdotal data, anecdotal information. And then he goes on to say we put 2 properties on the market on Wednesday. That would be Wednesday this week. And so far they've had 4 to 5 showings. So showings are continuing. I believe that to be true, although people also are buying groceries. You'll see them in the grocery stores, and they're not necessarily practicing social distancing. I suspect as the message continues to come home to people that life has to change a little bit until we have this virus under control, we will see a pretty dramatic drop off in buyer activity unless they're really quite serious. And the sellers are probably going to require some additional vetting before opening their homes to random strangers to walk through. And we'll talk about what that might look like toward the end of this presentation as well. So here's an email from one of, oops, I don't need to put that big red line on there. Here's an email from one of the lenders that we utilize frequently, and I'm leaving his email address and contact info in here because I think he wrote a pretty solid email, and I'm going to erase that. Let's see. Oh, there's an eraser. There's no point in having, there we go. So we'll try a highlighter instead. So I hope everyone's doing well. Sometimes are strange times. Stocks selling off. Everyone knows that. Rates are high. So this is the interesting part that most people are not in the awareness of, but our lenders are telling us, and that is rates are actually higher. And it doesn't make sense. And this is what I've been telling my clients as well, is that rates should be dropping, but as of right now, they're not. And the 30-year is almost 4%. It really should be below 3%. So the market's doing weird things, and it was low a few weeks ago. It was as low as 3% a few weeks ago. And then investors started to get overloaded. They throttled their rates to control flow. So they're not, the investors are not allowing just a giant flow of new mortgages to be originated below 3, at least for now. The market doesn't know what to do. Rates should, so this is what I just said too, rates should be at or below 3%. Today, it doesn't make sense to even quote people. Rates are changing like crazy. I had 12 alerts to lock today, and as the market was moving that crazily, things should get back to normal. I hope in as little as a few weeks. It could be a few months, and that's also the conclusion that I'm reaching, is that this could last for months or even longer. Time will tell. So he goes on to write about how he's working to get purchases in the pipeline closed as soon as possible. Counties are closing down. E-recordings and Gap Insurance are working for now, and a few title companies aren't hosting closings in their offices, and we'll talk about that at the end of this email as well. And there's some difficulty with getting verbal verification of employment, the underwriting process. So that's Ananda's message. Okay, so I went into my archive to see what did the last downturn look like. And as some of you know, I've been obsessively tracking the Boulder market since 2005. And during 2008 to 2010-ish, 2007 to 2010, we were in the midst of a pretty significant downturn. 2009 is probably the bottom. And in the summer of 2008, I started to put together a series of charts just to show you how bad it got. And this chart was published in September of 2008, and it shows the city of Boulder's sales volume for single-family detached houses as a percentage of the average of the preceding 4 years. So you could see both sales volume and inventory. And what this chart shows is the change relative to that 4-year average. The green bars are sales volume, the white bars are inventory. I'm going to change back to the red. Maybe we'll just do the laser pointer. So, so January and February are slow months. I wouldn't put a lot of weight in these two, but March, April, May, and June, these are the strongest months of the year for real estate in Boulder. And sales volume was off 25%, more than 25%, and then 25%, and then maybe about 20% off compared to the average. And inventory did start to decline. It didn't decline nearly as much as the volume declined in sales, but it definitely declined. So this was indicative of both sellers and buyers hesitating. Far more buyers hesitating, clearly, by the decrease in sales volume than sellers. Sellers were still coming to market, but a portion of them said, hey, you know, I'm going to stop and hold off. And as many people know, that fall, 2008, and into early 2009, there were quite a few deals on the market, and it was driven by this activity, by a decrease in buyer demand and slightly slower inventory coming to market, but there was still plenty of inventory, and that led a lot of buyers with wishful thinking pricing that they had sold it a year earlier. And the fall, late third quarter, early fourth quarter had some pretty good deals on the market. Here's another example of what the market did back then. And you can see that this is withdrawn detached listings, so single family houses, January through May. And I broke the market out into two different segments, $1 million plus and the entry level at that time, which was 350 to 400. And again, single family houses. And if you look at this, it's like the tale of two markets. 2006, 7, 8, and 9, you can see the volume of withdrawn listings. In 2006, it was only about 25, but by 2009, it was over 60 during that same time period. So more than doubling from 2006 to 2009. It did take a little bit of time for it to filter through the whole market, but it did get there, and inventory did increase, sales did slow down, and therefore sellers were failing at listing their homes. But the entry level, totally different story. It barely budged at all. Very few failed listings from 2006 to 2009. And I think this is probably, assuming we see a substantial decrease in market activity, assuming there is a recession and the market cools off, this is pretty much the same pattern I would expect to see again. More failed listings at the high end and almost no failed listings at the entry. So the market at the entry is extremely well supported in the city of Boulder, and this chart is for the city of Boulder, but is not quite as well supported at the higher end. Higher end buyers are more likely to hesitate, and that will result in more failed listings and potentially a better deal for higher end buyers in the fall. If you're shopping in the, let's say, 1.5 plus range today, you may be better served by waiting. But if you're shopping at the entry level, it looks like there's probably not going to be much of a difference, particularly given this coming recession may not be as steep and deep and long as the 2008 global financial crisis. Okay, just to put the hammer in the coffin, this chart is foreclosure trends. So at the time, I was using RealtyTrack, and I was pretty much going every week and downloading the data to see how many listings were in foreclosure, how many foreclosures were on the market. And I was really disappointed because I was hoping for a giant onslaught in foreclosures to take advantage of, but it didn't really happen. Boulder, and I started tracking this back in 2006. Boulder started, this is Boulder County, with about 500 properties in foreclosure. And by the time I stopped tracking in early 2008, it had reached 1,200. So more than doubling. But look at the other counties, and you can tell by the slope of the line, as well as the overall size, these other counties, Arapahoe, which is this little green dot, green squares, Denver, which is this pink circle and blue line. I'm sorry about these colors; they're kind of painful now to look at. But Jefferson County, the steepness of Jefferson's county increase. A lot of these doubled during that time period. But Boulder was it also more than doubled, but it started from a much lower number. Boulder had the lowest foreclosure rate of any of the surrounding counties. And although this chart doesn't show it, I did break down the cities within Boulder County, and the city of Boulder had the far lowest foreclosure rate as well. The L's didn't do quite as well as the city of Boulder, but it still was a relatively safe place to park investment capital, to purchase homes for primary use and so forth, compared to these other locations. Also, this is what I would expect to see in this coming downturn. Whether it's a 3-month downturn or a 3-year downturn remains to be seen. I'm betting on the shorter end of that, not the longer end. So we may not see much at all in terms of foreclosures. So this chart's actually a little bit out of order. We may come back to this. Well, let's just go there. So what's gonna happen? The market's gonna normalize, and it could take a couple of weeks till norms are established. It may happen faster. If you go to our blog at houseeinstein.com, you'll see the latest post on what should I do. At the bottom of that post, there are 6 recommendations we're making to buyers and sellers with respect to conducting showings and whether or not to bring your property to market. And if you're going to have showings, they really should only be for buyers who, let's go back to the highlighter. They should really only be for buyers who are truly ready, willing, and able. They should be pre-qualified, and honestly, they should be submitting some sort of signed statement of intent. You're letting a strange person into your house who may or may not be sick, may not even know they're sick. And in my experience, probably 50% of showings are by people who aren't serious or are just previews by the agents. So you really want to, as a listing agent, you really want to make sure the people that you're going into your clients' homes are actually real buyers. Are they real? And real buyers, I define it here, they're ready, willing, and able to submit an offer and close within 60 days. And if that's you, you really shouldn't be scheduling showings right now. This is not the time to be looky-loo. Um, in addition to that, I think the real estate commission should be stepping in with a standardized disclosure to let sellers know and buyers know before they walk into someone's home whether that home has been exposed to COVID-19 during the past 2 weeks. And I'm actually asking the real estate commission here to step up and write that standard disclosure. During the showing, buyers often just wander around and touch things and turn on and off lights. At this time, I think they should refrain from doing any of that. And it's the realtor who should be the one opening the door, turning on the lights, and they should consider wearing gloves. And sellers should be advised, the realtor should be advising them, hey, you should be sanitizing. We don't know who these people are. We don't know if they're exposed. And since a lot of the virus transmission is, the data is showing is happening asymptomatically, you should just assume that the people that are in your house have now infected it with COVID-19 and go ahead and clean all the surfaces. As well as open the windows to allow fresh air to be exchanged before reoccupying the house. And I know it's pretty much feels like winter right now, so the idea of doing that's is challenging, but at least allowing several hours of air transfer would decrease the risk of aerosolized droplets potentially infecting the homeowner or tenant in the house. And then title companies should be doing separate closings at this point for buyers and sellers. And I'll just at the next slide, I'll show you what land title is doing. I just got an email from them this morning about how they are changing their business practices. There's no reason at this point for buyers and sellers to be in the same room. And going forward, I expect we're going to be doing a lot more video. At House Einstein, we started doing this, I don't know, 5 years ago. And it involved remote videography and uploads where we're not trying to sell you the house, right? So the experience for most people initially is, why are you doing video? I can just look at the listing agent's video. And the answer to that is the listing agent's video is designed to sell you the house. And your buyer's agent's video should be designed to show you what's wrong with the house and give you a realistic perspective on it. We probably go overboard with what's wrong because we really don't want to waste time getting our clients excited about homes that have clear faults, especially for our reloads. So we started doing this primarily for reloads when clients can't attend in person. And our goal is, of course, always help our clients make smarter decisions. That's what our business is based on. And again, this has mostly historically been reload, but if we have clients here today that are interested, we're happy to do this as a non-relocation service too. If you're here and can't get to the showing or are concerned about health issues, we're willing to do the video for you. So here's a quick message from Land Title on how they are changing their business practices. And we noticed this with 2 closings for our company this week, that you can no longer bring pens. You can no longer leave your pen behind after you've signed. They want you to take it with you. And that they've been cleaning their closing rooms carefully. And I think that's what they were calling clean closings. And now they're moving to contact-free closings, which is exactly our recommendation. And this could even involve curbside closings. You can close in your car and not be exposed to an office environment. So I think I applaud Land Title for doing this. They're one of the top title companies in the state of Colorado, and I often wonder why agents choose discount title companies when it saves their client only a very small amount of money for a lot of risk. Meanwhile, you have Land Title leading from the front, so I really appreciate that. And here's our quick conclusions. We'll just go through this really fast. Again, most of the data we're seeing right now is anecdotal. That includes from our buyers and sellers, not just other realtors. And the vast majority are hesitating to some extent. And if they're already under contract, they're probably not willing to lose earnest money. They're probably going to go ahead and close. But some of the early stage contracts may break up. I did a quick analysis of return to market listings in February, and there weren't that many. There were 9 already. Sorry, in March, not February. Um, we'll see how many play out by the end of the year. Return to market means that the deal broke up and the listing is now active again. Data really won't be um, clear to us until early April, and I'll jump ahead to that. All we have right now is these anecdotes. We won't really know what happened this month until early April. There's a new normal happening, beginning to form, and that new normal will involve additional procedures and hurdles for buyers to pass through to actually conduct a showing. And if you're a seller, I would be asking your realtor to put those hurdles in place. You do not want to have random people that are not actual buyers, not ready, willing, and able to close in 60 days in your house. There's no reason for them to be in your house. So um, primary home markets are going to track the general economy and unemployment. That's the historical norm. Secondary home markets, Aspen, Jackson Hole, Nantucket, tend to track the stock market. Um, and keep in mind what's happening in the stock market right now leads the economy. It's an indicator of what may be to come, not the other way around. So when the market's dropping, it's a really good sign that the general economy is going to go with it. And that's from my Wall Street days and my equities research days and private equity research days here in Denver. I can assure you that that's what the market typically does. And well, how long will this last? How quickly will it recover? It truly could be V-shaped if the pandemic is successfully halted quickly. If it's not, and we're in a long lockdown in Colorado and nationally, it could be another prolonged downturn similar to the global financial crisis of 2008. It's way too early to tell. So right now, everyone's just tapping the brakes and saying, hold on a sec, what's about to happen? What should you do? It really depends on your circumstances, whether you're a buyer or a seller, which market you're in. Are you in the city of Boulder? Are you in Longmont? Your price range, your property type. And I covered some of that on the latest blog post. You can check out some of those ideas at houseeinstein.com. You'll find our blog is available for you as a resource, and we'll continue to publish our thoughts as well as get back to normal content, which includes fresh listings and notable sales, as well as an analysis of what's happening in the market. So I hope you've enjoyed this presentation. It's the first video slide deck that I put together. I think it's an interesting way to convey information from lots of different places. And if you'd like more, visit us at houseeinstein.com. And you're always welcome to reach out to me at osman@houseeinstein.com. My phone number is 303-746-6896. All right, everyone. Have a great day. Thanks for joining me.